In modern life, income is not just a number that reflects financial capability, but also the foundation for personal stability and growth. However, having an income alone is not enough. Knowing how to manage your earnings effectively is the key to achieving financial freedom, staying secure amid economic fluctuations, and working toward greater future goals. This article will help you better understand income sources, optimize cash flow, and apply smart financial management strategies. Whether you are just starting or already experienced in personal finance, mastering income management scientifically is always a crucial step toward building a stable and sustainable life. Unstable income, irregular or fluctuating earnings over time. Unstable income refers to a situation where an individual or household does not have a fixed and predictable source of earnings each month or period. This can arise from various reasons, leading to financial fluctuations and affecting spending, saving, and long-term planning. Below are the key aspects to understand this issue better. 1. Characteristics of unstable income. No fixed monthly salary. Some jobs do not offer a consistent salary as income varies based on products, services, or work outcomes. Seasonal fluctuations. Certain industries have seasonal income patterns, such as agriculture, tourism, or festival-related businesses. Income may rise during peak seasons but drop during off-seasons, dependent on customers or projects. Freelancers, independent business owners, or contract workers do not receive a steady paycheck and rely on the number of clients or projects they secure. Influenced by external factors. Economic crises, pandemics, policy changes, or market trends can significantly impact an individual's or business's earnings. 2. Groups prone to unstable income. Freelancers and temporary workers. Those working on a project basis or short-term contracts often experience fluctuating income. Small business owners and online sellers. Their earnings depend on customer demand and market conditions, leading to irregular revenue streams. Farmers, fishermen, and artisans. These professions rely heavily on weather conditions, seasonal cycles, and consumer demand. Artists and entertainers. Singers, actors, writers, and painters often have inconsistent earnings depending on contracts and sales of their works. Salespeople and brokers. Individuals who work on commission-based salaries earn money based on the deals or clients they close. 3. Impacts of unstable income. Challenges in financial management. Without knowing exactly how much they will earn each month, budgeting and saving become difficult. Psychological stress and anxiety. The uncertainty of income can cause worry, especially when fixed expenses like rent, utilities, or tuition fees need to be covered. Difficulty in obtaining loans. Banks often require borrowers to prove stable income before approving credit. Those with irregular earnings may struggle to access financial support. Limited long-term planning. With fluctuating income, it is harder to plan for the future, such as buying a home, investing, or saving for retirement. 4. Solutions. For managing unstable income. Build an emergency fund. Having savings equivalent to 3 to 6 months of expenses can help during low-income periods. Diversify income sources. Relying on a single income stream is risky. Finding side jobs, investments, or additional business opportunities can enhance financial stability. Create a reasonable spending plan. Prioritizing essential expenses and avoiding luxury purchases during uncertain financial periods is crucial. Seek jobs with more stable income. If possible, consider transitioning to roles that offer fixed salaries or combining stable and flexible income sources. Improve financial management skills. Budgeting. Tracking expenses and controlling debt can reduce financial risks caused by income fluctuations. 5. Conclusion. unstable income is a reality for many people, especially in today's economy. While it presents challenges, proper financial management and strategic planning can help individuals with irregular income achieve stability and financial security. Income insufficiency, when living expenses exceed earnings, leading to debt or lack of savings. Income insufficiency occurs when an individual or household's earnings are not enough to cover their living expenses, resulting in financial difficulties, debt accumulation, or an inability to save. This is a common issue, especially in times of rising costs of goods and services, while salaries or income levels fail to keep pace with inflation. Orange 1. Causes of income insufficiency. Several factors contribute to income being insufficient to meet basic expenses, including 1.1. Low income. Salaries do not increase in line with the cost of living. Many people earn low wages that do not adjust for inflation, making it harder to afford daily necessities. Unstable employment. Seasonal workers, contract employees, and those with irregular jobs often struggle to cover fixed expenses. Limited career advancement opportunities. Certain professions have limited income growth potential, making it difficult for workers to improve their financial situation. 1.2. High living expenses. Rising costs of goods and services. Inflation drives up the prices of food, fuel, utilities, housing, and essential services. Expensive rent and housing costs. In major cities, high rental prices can consume a significant portion of a person's or household's income. Healthcare and education expenses. These costs continue to rise, especially for those without insurance or financial support. Uncontrolled spending habits. Some people struggle with impulsive spending, making unnecessary purchases that strain their budget. 1 through 3. Debt burden. Borrowing money for daily expenses. When income is insufficient, many people rely on bank loans, credit cards, or personal loans to cover their costs. High interest rates lead to growing debt. Without careful financial management, debt can accumulate rapidly, worsening financial struggles. Student loans or mortgage payments. Large loan commitments can become a financial burden if income does not adequately cover repayment obligations. 2. Consequences of insufficient income. When earnings are not enough to cover essential expenses, various negative impacts can arise. 2.1. Financial and mental stress. Constant financial worries can lead to stress, anxiety, and even depression. Sleep disturbances, reduced work performance, and deteriorating mental health due to financial issues. Strain. 2.2. Decline in quality of life. Inability to meet basic needs such as adequate food, healthcare, and education. Limited access to leisure, entertainment, or self-development opportunities. 2.3. Lack of savings or emergency. Funds. When income barely covers expenses, saving money becomes nearly impossible. No financial buffer in case of emergencies, such as job loss, accidents, or unexpected medical bills. 2.4. Increasing debt accumulation. Frequent borrowing leads to a growing cycle of debt. High interest rates make it harder to repay loans, causing long-term financial instability. 3. Solutions to improve income insufficiency. Although financial difficulties can be challenging, several strategies can help improve the situation. 3.1. Effective expense management. Create a budget plan. Track income and expenses to ensure financial balance. Cut unnecessary spending. Avoid impulse purchases and limit non-essential expenses. Prioritize essential costs. Ensure that necessities like food, rent, and utilities are covered before spending on luxuries. 3.2. Increasing income. Seek better job opportunities. Enhancing skills and qualifications can help secure higher paying jobs. Take on side jobs. Consider freelancing, online selling, tutoring, or part-time work to supplement income. Invest for long-term. Financial growth. If feasible, explore investment opportunities in stocks, real estate, or small businesses. 3.3. Debt reduction and credit management. Use credit cards responsibly. Only charge what can be repaid in full to avoid high interest charges and make timely loan payments. Prevent high interest accumulation by paying off debts on time. Negotiate loan terms with banks. If struggling with repayments, discuss options for lower interest rates or extended payment terms. 3.4 and 4. Building an emergency. Fund even with financial constraints. Saving a small amount each month can help in emergencies. Utilize financial management apps to monitor spending and improve budgeting habits. For conclusion, insufficient income is a widespread issue that can lead to debt, financial stress, and an unstable lifestyle. However, by managing expenses wisely, seeking ways to increase earnings, and effectively handling debt, individuals can gradually improve their financial situation and work towards a more stable and secure future. Having an insufficient income to cover expenses is a major challenge for many people, but it is not an unsolvable problem. By managing expenses wisely, seeking opportunities to increase earnings, and handling debt smartly, you can gradually improve your financial situation and work towards a more stable life. Most importantly, maintain a positive mindset, stay committed to your financial plan, and continuously learn to grow. If you found this video helpful, don't forget to like, share, and subscribe so you won't miss any future content. Leave us comment below about financial topics you'd like me to cover in the next video. See you in the next one.